You invest to make money, but when you succeed, you'll have to pay taxes on the money you made. Minimizing those taxes can make a big difference. But first, let's take a look at the basics. There are two ways to make money on investments: capital gains and investment income. Capital gains happen by following the age-old advice to buy low and sell high. The difference is called the capital gain. The tax treatment of capital gains depends on how long you held the investment before you sold it. If you held it for less than a year, any money you made on the sale is considered a short-term gain. In the government's eyes, short-term capital gains are no different from money you earn through a paycheck or a side gig. You'll pay income tax on them. If you hold the investment for longer than a year before you sell, any capital gain is considered long-term. Long-term capital gains are better from a tax perspective because they're taxed at lower rates than income, either 0%, 15%, or 20%, depending on how much you earn. The other way to make money on investments is for your asset to pay you income for holding it. Ordinary stock dividends and interest payments from bonds are generally taxed as part of your income. There's also a special class of dividend payments called qualified dividends that are taxed at the same lower rates as long-term capital gains. We'll talk more about that in episode 11. One other wrinkle to consider: people with high incomes pay a 3.8% surtax on net investment income. That tax applies to single filers with more than $200,000 in modified adjusted gross income and married joint filers earning more than $250,000. Back in episode 3, we talked about the power of compounding, that is, reinvesting your returns to earn more returns. If you understand how the government taxes your investments, you can look for ways to minimize the tax you pay. That way, you can put more back into your investments in pursuit of long-term growth. On a more basic level, there's a saying: if you don't get to keep the money, did you really make it in the first place? Tax-advantaged investment accounts such as IRAs, 401ks, health savings accounts, HSAs, and 529 college savings plans can reduce investment taxes significantly. Each of these accounts comes with specific rules about when you can withdraw your money, or in some cases, what you can spend it on. If you're investing for retirement, healthcare, or education, consider one of these purpose-built accounts. To refresh your knowledge on those accounts, watch episode 8. Certain strategies can help you manage taxes in an ordinary taxable brokerage account. Try to hold investments for more than a year. That way, you'll avoid short-term capital gains taxes and instead pay the lower rates on long-term gains. If the market drops and you wind up selling investments at a loss, you can use the loss to offset capital gains. Remember, you have to be out of a losing investment for at least 30 days in order to preserve the loss for tax purposes. Some investors do this on purpose, using a method called tax loss harvesting. It can be complicated, so if you're considering it, consult a tax advisor who knows the ins and outs of our complex and often changing tax code.